Hey everyone, and welcome back. In today's video, we discuss everything to do with the stock, commodities, and crypto markets right now in our special weekend edition, looking forward at the new week ahead. It's been volatile, it's been fast, and it's also been incredibly aggressive to the downside. But the question is, will tensions, inflation concerns, and the Fed basically doing nothing continue to push these markets down? The answer might be more disturbing than you think, so stay tuned as we go through all the key levels for you to be looking at throughout the markets for the week ahead. See you soon. Okay, well, welcome back to our special weekend edition for everything to do with the stock, crypto, and commodities markets. And if you follow any of those, please remember to subscribe and smash that like button if you end up enjoying the video. Let's take a look here at the broad market close for the 18th of February 2022. And this is the stock market and the large companies. These will push the cryptos and commodity spaces when you understand that all these markets are partially connected. Let's talk about semiconductors. That was, of course, the big story of the week. We went a little bit bearish here on NVDA, which is against the grain, and we'll explain it why later. And I think that's going to be the story of today's video when we go through all of these, is why you maybe need to be thinking a little bit outside the box when it comes to markets. But let's discuss what happened through the Friday session first. It was a buy in the morning, buy in the dip, the retail traders were coming out in force, and everything almost went positive. But then the sellers came in, and this is what Wall Street loves to do. They're selling into a long weekend, which obviously is happening in the US. The Monday market will be closed, and then they have a small rally followed by a sell-off at the end. The Nasdaq ending up 1.21% down, straight into a big key support level that we'll be talking about later. But another thing happened with the sectors, and that was that we saw defensives continue to really hold up. XLP, the number one best performer, that's consumer staples. Of course, financials not doing so poorly in a higher interest rate environment, which is what we're going to see soon. And it was all growth stocks that were getting hurt. In particular, funds like Cathie Woods were getting absolutely destroyed. And we'll talk about that later as well, as I think there's some problems on the horizon before we see a turnaround. So let's go back to whether this crash or correction or whatever you want to call it is the real deal. And a lot of people will try to look at this and say, okay, how do we figure out whether we should be buying the dip, whether we should have a longer term plan, or whether this is the next big recession? And I think this is one of the big key factors. We've got one of the biggest markets, it is the biggest market in the world, households, and obviously mortgage debt has caused many crises in the past. Mortgage debt as a percentage of GDP is a stat we have here, and we've seen that steadily decline since the GFC. We actually saw its peak over here because, of course, the US GDP was dropping during the pandemic, but it hasn't really increased. And this is an important factor and one of the lead things that we often look for here on the channel towards big problems in an economy. So just remember that it's one of those things that you should be looking at. Another thing that I think is very, very important is to bring up whether we are in a sell the rumor, buy the fact style economy. Remember, at the moment, the Fed technically has got a very good jobs market. We see that jobs are really good. Unemployment is, of course, dropping. And whether it could be like a little bit of, let's call it semi-unemployment because people aren't working as many hours, it doesn't really matter. That is also one of the, while it's a lagging indicator, one of the key things that you look for recessions. We're not currently seeing that. So what has historically happened during first rate hikes? Well, funnily enough, the market has generally gone up over the next 6 months and 12 months. In fact, the 12-month statistics since rate hikes have begun has been 100% increase after the first rate hike. Yes, you heard that. 100% increase with a 10.8% average return. So if we're considering this market sell-off here to be about inflation, overall it will be the Ukraine tensions are one thing, but as we know, most of those types of things hopefully will be sorted out. We've got 50% in terms of return over the next 3 months after the rate hike comes in, expected to be March, and then the next 6 months, a 75% return. And it falls in line with everything that we've been discussing here in markets. Let's talk about the seasonals. Obviously, we expected midterm year to be the traders' year. This is one of the worst types of years to be in markets. Midterm election years in the US, there's something about them. They tend to have actually a double dip style kind of movement. So we get weakness in the first quarter followed by an uptick after March, which is something we are looking for this year. And we'll talk about that later. and then this big kind of rally that comes through in the middle of the year, followed by a second dip that often happens in the third quarter. And then hopefully we go through with the stats to go more positive. Let's talk about some of those stats. So if we're thinking about the normal midterm election years, this is 70 years of data. We tend to have that up, down, and all around at the beginning and at the end. If you're looking at the bigger picture, and again, we don't see certain things, and there is one other indicator that you should be scared of if it happens, a very important one, which we'll talk about soon, that we could possibly be looking at an incredible opportunity for people that hold their resilience and have a plan coming into this current crisis in the markets. So let's go into some discussions about some of the things that we're seeing in the markets right now. But firstly, I want to talk about yield curve inversion. So basically, this is where the yield between the 2-year and the 10-year kind of invert. We end up seeing it go negative or positive, whichever way you've actually set it up. And we don't really want this to happen. In fact, this has been a precursor to almost every single major crash out there, whether it be the GFC, whether it be the dot-com boom, whether it be other crashes in the market in the past, or even before the pandemic. It's slow. And what I mean by that is this particular indicator comes in, it warns you of impending doom, and then the doom ends up happening 12 to 18 months later, even up to 2 years. So it's such an early indicator that it's often way ahead of the market and problems. Now, this is what most traders, most investors are looking at. They are laser focused on this chart, making sure that they don't see this particular thing, because I think that's something that will concern the markets greatly if it does end up incurring. Let's talk about the VIX, the volatility index here. This was still much higher. Obviously, it rallied throughout the day and then sold off. The only reason it didn't go higher in the end was because we haven't made a new low on the major indices. And we'll talk about making a new low and whether that's possible for the week ahead very, very soon. So VIX still increasing, but overall, it will need the algos to come through. And that will only happen when we break key supports on the S&P and Nasdaq markets. Let's talk about gold. Gold continues to do pretty well. Look, we've been very bullish here on the channel over the last couple of weeks, if not couple of months, in terms of gold and the fact that it was most likely going to go up due to a mixture of seasonal events and also the fact that it was starting to look better technically. 1910, 1900 still remains a very big resistance. If it breaches this through the next week, we go towards the 1960. And I think if we break 1960, you're probably looking at all-time highs for gold. So it's one of those markets that usually is short-lived in terms of its trading potential. And then once it goes and it moves and it goes in a very big direction, it tends to then consolidate for some time. If you don't believe me, just go look at the left-hand side on these charts. Huge rallies, mass consolidation, huge sell-off, mass consolidation. Know what you're trading. The instrument that you trade or the instrument that you invest in is incredibly important to understand. And in this case, gold is more of a trading tool, but we've seen materials across the board increase. Let's talk about oil. Oil is pretty weak here in the markets. I know it rallied through the Friday session, but it's broken the trend line that it's been following all the way up, and then it's broken below it and rallied back into that point. I think for traders, they're going to be looking for signs of further weakness coming through here. Obviously, tensions in Europe are really pretty much spiking this, but it isn't as strong as you would expect. And I think a lot of that has to do with the real factor that it's very extended. We've talked about the weekly 20 moving average quite a few times. And really for oil traders, they're now looking for a break below that kind of 89 area for the week ahead to get further shorts in. And the main target's going to be around 84. And you can see here on the weekly how it looks. It's so far away at the peak up here, 18% away from the weekly 20 moving average, exponential. That is a huge distance and in fact incredibly extended. Let's talk about Tesla and the stock market, and it's not good across the board here, but there is good signs for bulls because I believe we now know where the bulls are going to be in full control of the market should it occur. And Tesla is one of the same ones, 945. I mean, you see it here. Rejection, 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 weekly 20 moving average. If we close above this closure here, it means that the bears have been faked out towards the short and they're going long. So if you're a bull in Tesla and it gets past here, I think the actual power through that level could be extremely good moving forward. But right now, we are not seeing that. The weekly rejection is pretty horrible. It's across the board through all of these, and it's pretty damning for the market. So if you think about where Tesla closed, it closed right on support. You might get some rally maybe in the Tuesday session, but of course you close through this level here and actually get a nice daily close or bigger time frame. Where's the next step for Tesla? You could easily see it getting back down to $800. And it does have a series of seasonal weaknesses that come along with it over this Feb-March period. Remember, we're not even in March yet. We're still in Feb. And it tends to have this kind of seasonal weakness over this period. And this is going through all of history. Remember, it doesn't just allocate for the 2020 period. And then it has that mass retick. Now, at the beginning of the video, we talked about this idea that we might see weakness. Then after we flick the switch, after we get the actual first rate hike from the Fed, and all of a sudden it becomes a buy the market after the rumors happened. A big, big trap. Let's think about some of the big earnings we've seen recently. Tesla, earnings comes in, everyone's FOMO, going to be a great result. Result wasn't that bad. What did the stock do? It went down. NVDA, amazing, amazing result. Did really well, beat the market. But because the expectation by retail is so hot going into that, and it was hot into NVIDIA, admit it to yourselves, you knew that everyone loved that stock, it suddenly sells off. And it's why we turned a little bit negative on it this week, because when you're looking at the valuation in comparison to other market competitors, it was just too expensive. So here we have Tesla, and we have this potential for this mid-year kind of gain if it can turn around. And if all these things come true and we see nice bases on the technical bottom, you could be looking at serious months of return there if you get it right. So weakness here, we've looked at it. We know where the strength's going to be. And I think day traders are going to do the best on Tesla stock for the next coming weeks. Let's go into NVIDIA. So again, a huge buy the rumor, and it turned out to be sell the fact. The earnings were good. Didn't matter. We ended up getting up to this level of previous support acting as resistance, the downward trend line. And we've done something that I think a lot of NVIDIA fans would be sad about, and that is reject this level twice. This level is seriously big, and the double rejection, a tweezer pattern here to the downside, is not to be underestimated. This is the type of candle formation that if I see it, usually does mean weakness and continued weakness. If it's in the strength side, so that is going bullish, and you see follow through, that is the market goes to a higher level, it's extreme. And that on the bull side, that makes me very happy. I get very smiley face when I see that type of thing. But here we have it on the negative side. So we break to a new low after the Friday close. Where does NVIDIA go? It seems very likely $200, the previous trend line. That's where buyer demand will be had. And of course, that's going to be a big zone of bulls and bears fighting it out. But be warned, NVIDIA does not have a good price on it at the moment. Now, if we're wrong and it ends up going bullish and closes past here, very strong to the buy side, taking out all the shorters. So you really have some good shorts coming up here in the week ahead. And if we get follow through, there could be big movements towards the downside, followed by some potential buy levels as well. Now you might ask, well, why did this happen, Tom? Why did the markets go down, and did retail really get trapped? This is probably the chart that you need to see. Calls everywhere. Where were they? All higher. 300, 275, 260. All of these calls coming into the announcement. Very bullish sentiment. It hits it, and then all of a sudden Wall Street sells it off. What happens? Retail lose, Wall Street win. It's the age-old game that we've always seen. Semiconductors on this sector is something that I want to look at as well. It looks very similar to NVIDIA here. A triple rejection. There's the long leg doji, rejection candle, rejection candle, rejection candle. Big support around 260. We breached that, and we could be looking at some pretty big sell-offs here. Obviously, 250 would be the first target for shorters in the next week. And then underneath there, we're looking at that 225. So again, some weakness here coming through one of the best performing, what is the best performing sector in the markets. And that's scary. Let's talk about ARK. Oh, Cathie Wood is copying it. I mean, even Kramer's attacking her. Yes, I said that. Kramer is attacking Cathie Wood on television. If you haven't seen it, you can go and watch him go crazy. But a lot of people have been interviewing her. They are really hammering her now. and she's getting it, and she's basically she's starting to look a bit freaked out, I gotta say. When you see her interviews, a little bit more freaked out than they were. But let's take a look at her fund from more of a technical aspect. So we've been talking about how this market is the most hated on the market. Obviously, it doesn't necessarily, it's filled with companies that don't necessarily make any money in terms of be profitable. They are the most hated sector in the markets, and it continues to decline. We haven't seen the turnaround story just yet. The daily 20 moving average, the red line here, remains the big resistance level, and we're right on the support here, which makes sense to the market. And unfortunately, she copped it again with the Roku result. Roku went down very hard. It actually dropped into 105 and then went post-market, ended up getting back to 113, but another terrible result for her fund. It's unfortunate. It is what happens, and often the people that do the best, when they might have the right vision or maybe even the right companies, at some point when they've performed so well, the market will end up turning and they'll have the worst fund, and it's historically incredibly statistically accurate, and that's just something that does happen. If you're interested as well, we're posting quite a lot on Twitter at the moment, so follow us at FX Evolution, and we've got a whole bunch of posts there, including our old intro. We've brought it back if you want to go check that one out for the live streams. Let's talk about IWM, Russell 2000. This is where things get truly scary for the stock market. Now, we've detailed here the legs. So this is basically the A, the B in terms of movements. Will we see the C? And we've basically detailed why the pullbacks have happened in unison. It makes sense. This is a Wyckoff distribution. There's the max pain. Obviously, we've seen the breakout through. And think of the Russell 2000 as the lifeblood of the market. This is the small cap companies. These things matter. And they matter a lot when it comes to the health of the economy. So if we got rid of these particular candles here, even though we're looking at basically a flag pattern here, think about what the Russell has just told us in this market. It's basically said rejection off the role reversal, rejection again. If you get follow through in the next week, oh man, this could be pretty brutal, guys, and it's going to go to this distance. And why do we believe that distance? Well, firstly, weekly 200 moving average, but let's zoom out. Da-dun-da-dun. Oh no, that's not good. That's not good. 170, previous resistance from other years, becomes support. The price action is pointing towards that. The legs, the A, B, C kind of make sense. We've detailed many times that the C pattern, or the last kind of big leg here, tends to only be about 80%. But where would that put it? Right on the 200. And the 200 weekly is a serious moving average. So be careful out there. Look to the IWM. It's going to be one of those things that I'm watching very closely. And if that ends up making new lows in the next week, the shorters may really come out and push down this market. The Nasdaq is the same. You look at the Nasdaq. Do you look at that and go, oh, I love to buy the Nasdaq right now? You probably don't. It doesn't mean that if you buy it for 5 years, you're going to be wrong. You're probably going to be right and laughing at all the bears. But for now, look at these rejections. Again, rejection, rejection, rejection. This is showing every single rally is being met by sellers putting it through. Who are those sellers? Wall Street predominantly. Who are the buyers? Unfortunately, it's mostly retail. So we're pushing down here on the 14,000. You can see that's previous resistance, a big deal. You breach 14,000. Where do we go? Well, I think the SPY will probably tell us, but it could be as low as 13,000 fairly quickly here on the NDQ. I mean, basically the Nasdaq, the QQQ here, it could go very, very low because that's just the next level of support. Big things happening here. Let's take a look at the 1 hour chart just to understand what happened over the last week and why we weren't necessarily that bullish. A bit of it has to do with this resistance, support, becoming resistance again. It rallied up, it tested it twice, it dumped off, and now it's pressuring here. Is it all over for the bulls? I mean, obviously they might buy through here and you've got to be prepared for that in the day trade, but we remain with the same idea. If the VIX is above 20, unless you're buying investments for the longer term, you should be day trading and scalping and being nimble and being fast. That's how you make money in these markets. Let's talk about the SPX. It rejected again. The double tweezer ended up being very strong. It went into our zone, rejected it down, and now we're sitting on the weekly 50 exponential moving average. This moving average is so pivotal. If we get underneath that, historically, wow, like a lot more shorting begins. And that's where we're talking about things like a 4,000 or a 3,800. Remember, they make sense mostly because where do bear markets truly start? Around 20% lower in the markets. What would this force? A 21 or 20% from top to bottom for the SPY. This is not a broad-based sell-off. If you look at the energy stocks, they're doing well. The financial stocks have done well. The agricultural stocks have done well. They're just sitting there doing nothing, really. This is all about growth because inflation can smash growth, as we know, at least temporarily. And look at the turnaround here. The weekly 50, that is certainly a huge level of support. We closed above the options, the big ones, the 425 and the 430s and the 435s for the SPY on the weekend. So that means that all of those poor puts expired, mostly worthless. And we've created effectively a big turnaround here because we have a peak, we have a trough, we have a lower peak, and we have a lower trough. Now, a lot of people are going to point to one thing here. Is this a right-hand side shoulder? Here we have the left shoulder. Let's make that S a little bit better. Here we have the right shoulder. Here we have the head. That is what people are looking at. Now, it's not that we've just seen this. It's been there for a while. But we can start to discuss the storyline should that occur. If you take the distance from the head to the neckline, which is basically these body wicks here, and you extrapolate that out, what does this end up forcing? Da-da-da-da, what do we see? 3,800. Where is that? The full length of the bear. So I think this is the logical conclusion should the markets get to the low. 4,000 and 3,800 become very open. The pricing, the stock, the market, the way the price action looks, everything that kind of points towards the Fed wanting volatility to take the heat out of the market, which helps in their long-term battle with inflation in some ways. This kind of makes sense. And a lot of big brokerage houses were sending out alerts last week to all their high net wealth clients and big investors saying that's what they're expecting. That is actually one of the big scenarios that they're looking at right now. Increased volatility, further downside action, and the Fed doesn't care because they don't see this being a systemic issue with the overall economy. In fact, they would like it down here. It would make their day. They'd be very, very happy with themselves. So S&P 500, there's some of the storylines that we're looking at. For the week ahead, when we open up, look for little bounces in the session around this point. It's going to be hard to breach 4,300 easily, and I do think there will be buyers at that level. But if it gets through the 4,300 and closes below, especially on the daily, look at the closure points. Remember, we haven't seen a closure point lower than even this 43.20. So if you get underneath 4,300 with the daily closure, that is a big signal that things are looking very bad. And you kind of expect something like this, and then a very big potential for these levels to possibly come in over the next coming months. So keep an eye out there, and of course, be aware of what's going on in the markets. Will it happen this week? Well, here's the Friday options expiration. Didn't want to pay out a large amount of those puts. This is the next week ahead in terms of the 25th expiry. There are some puts still here in terms of the 425. Predominantly, there's still more puts in the market itself, but you've got to remember where's the big one. That's sitting at 400. And we'll watch this throughout the week to get a bit of an idea. Eventually, the markets do need to be let through. So this might not be as good as previous weeks have been as supporting the markets. Bitcoin and Ethereum and all of those things, again, moving with the markets here, weakness across the board. Bitcoin rejected 46,000. It's then sold off. We've seen this market kind of come down again here with Bitcoin rejecting this 44.5. It's gone underneath that last low. It doesn't bode well for it. And I think the crypto market is less about crypto and more about the stocks. If the stocks continue to get belted, the crypto market most likely will also fail a little bit. It's on support here in the weekend, so we may see some rallies. Look to 42,000 for a potential sell the rip. Maybe there's going to be some turnaround stories there, lightning bolts, rejection wicks, all these types of things with your systems that are around that level. But it's not positive here. Effectively a little double top on Bitcoin. And if it got through 46, hey, the FUD's gone. But that is not looking likely at this stage. Ethereum is the same. It's putting big rejection down here. Watch Bitcoin more than Ethereum because it often leads the way. But yeah, it's still weak and all the alts look the same. In terms of the news for the week ahead, obviously Monday is a public holiday here. You can see bank holiday in the US. There's not a huge amount of news coming out, so the markets will be allowed to kind of do their own thing. Obviously, tensions in Europe remain pretty much the forefront of next week's discussion. And then we've got the core PCE price index as well, 8:30 a.m. New York time on Friday. So it's going to be an exciting week. Day traders are going to be coming out. Scalpers are going to be coming out. And I want to give a shout out again to the Discord community, our public one and private ones that you can click on the links in the description below and join. Come on in, because people were smashing the shorts this week. And I've got to say, they had some good TA. Maybe they've learned it from somewhere. Who knows? Make sure to subscribe and, of course, smash that like button if you enjoyed the video. We'll see you in the next one, and have a great weekend, everybody. Bye for now.